all the data and what you've seen over this long career is that the highest paid people that predict the future are basically wrong.
Yeah.
Okay. So knowing that, how do you step in to view markets?
Look, within all that, we all operate for some baseline, right? If I thought that, the sky was going to fall tomorrow, like you'd behave differently. So in general, I'm imagining a future that's largely consistent with the past over long periods of time. America will grow. We will have GDP growth. We will have population growth. Inflation will be under control. I operate from that general baseline. And I don't, from there, then try and predict where interest rates may go next year. The question is, in that baseline and with asset prices and capital markets, does the deal make sense or not today?
Michael, welcome to the show.
Great to be here. Thanks.
If you've already made it this far, I just had lunch with Michael, and I can assure you this is going to be a 10 out of 10. So I cannot wait.
Don't set the expectations that high.
Come on, baby.
All right.
All right. I want to spend just a little bit of time in your Wall Street days.
Okay.
How did you get onto Wall Street?
I worked as a legal assistant during the day for a firm called Prudential Securities. It doesn't exist anymore, but it's part of the Prudential Insurance Network. But they were down at 127 John Street, lower Manhattan, while I was going to law school at night. And I never had the ambitions or thought about doing Wall Street. I wasn't sure what to do. But working in the legal department every day, I got exposed to the business. And when it came time for graduation, all the lawyers said to me, literally to a person, you don't want to do this for a living. The guys on the business side make more money and have more fun. And so luckily, the person who ran the legal department helped me get a job in the investment bank. And I kind of talked my way into a job in investment banking. And the next thing I knew, I was in training. So I fell into it.
And the pathway from there to Morgan Stanley was?
Well, now I was in investment banking, and I got dropped into the real estate group because this is 1994. And so Wall Street is bailing Main Street out. All the REITs are going public. And but I knew, being in the business now, that Prudential Securities was what you might call a second tier investment bank. And I knew in that business, brand was very important. And there were other brands out there that had a higher cachet in the world. And as a young person making my way, I wanted to be with the best brands I could be with. And so I went actually for a short stint to Salomon Brothers, which was a step up from Prudential Securities. But while I was working for Salomon Brothers, they got acquired by Smith Barney, which I viewed as a step down. And then Smith Barney got acquired by Citigroup, which I viewed as a much bigger step down. And so then I kind of put my hand up and I was able to secure an opportunity at Morgan Stanley. But by then I had kind of 3 or 4 years experience in the industry. I knew people, I had my own reputation, and I was able to transcend the Brooklyn Law School tag or label, which was a brand that would not have gotten me into Morgan Stanley, to a job at Morgan Stanley, which, at that time was clearly the best real estate, investment banking, investment management, lending shop on the street. So.
Okay, rumor has it that when you got acquired by Citi, you may or may not have been asked to sign up for a checking account.
I did.
On your way in.
Yeah. I mean, that was the thing. Like, I'm walking into the building at 388 Greenwich Street, which was the Smith Barney building, and they have tables set out where they're trying to hawk checking accounts to the employees who work there. And I shook my head and I was like, I need to go upscale, not downscale. This is the wrong direction, Michael. And that's when I made the decision, like, I'm going to find an opportunity away from here.
So when did you land at Morgan?
98.
Now, okay, so you were there for 10 years before the financial crisis.
Yeah.
Maybe talk about for a second what you went through in like 2000, 2001, and then what 08 looked like.
Well, it was interesting. In 2000, 2001, all of a sudden, nobody was interested in real estate. Everybody was interested in .com, whatever .com meant. And so in the real estate group, you're trying to figure out how to make money and stay busy. And so we reinvented ourselves into realestate.com folks. And you won't remember any of this because you were way too young. But there were networks. You had the office REITs who banded together to form Broadband Office to wire all their buildings with telecommunications. And then the apartment industry, led by EQR and other firms, formed consortiums to wire all their buildings. And so I got to work on these really interesting telecommunications infrastructure projects for the real estate industry. But when the NASDAQ crashed, that was over really fast. And people all of a sudden woke up and said, this cash flow, this is pretty good. This real estate might not be so bad. And we turned ourselves back into regular old real estate guys and put the .com stuff away.
And for perspective, like, how quickly does that go away? Is it like one day it's great and 60 days later, it's toast. Did you see it coming, or was it almost like overnight?
That was a little less. I mean, I wouldn't say 60 days, but it happens week by week, month by month.
Yeah.
It wasn't 2 years.
Yeah.
You just saw the .com piece just exploding beginning in 98. Really remember, Netscape Navigator comes out in 94.
Yeah.
It's really 96, 97 where this internet thing is, okay, this is definitely going to be the next new thing. And by 98, it was starting to be of interest to the real estate community. By the end of 98, I mean, I could be wrong by a few months.
Yeah.
It was like, okay, funds flows were moving away from real estate. M&A activity was moving away. And we need to figure out how to continue to run our business. So, but months, not weeks.
And on these telecommunication projects, they're so hot and heavy. Everybody's loving it. The go-go days are awesome. What happens once the capital flows stop going into that? Do they literally just shutter and end, or do you just buy bits and pieces of them and other people run with them?
Luckily, the work that I was involved in, neither of these got off the ground.
Okay.
Meaning the infrastructure, they got to the point, they raised some capital, they had all the contracts, the market participants were in place. But by the time it became, okay, let's wire the buildings, the NASDAQ crash happened, the business plans were folded up and people started over again. So I didn't get involved in the bankruptcy of these businesses and, what you have to do with them.
Okay. You've kind of been on the record saying 08, 09 might have been some of the most formative learning years of your career. What was that like for you?
It started in 07.
Okay.
In 07, I'm an advisor. I'm a banker working for some pension funds who had very, very large residential exposures. And for the first time in my life, I'm involved in bankruptcies and restructurings. And I'm advising. These are multi-billion-dollar investments, and things went upside down, in the residential space, really fast. And for one reason or another, I led the assignment. I had the opportunity. And so I was working very directly. And you know what you don't know. And luckily, I have a brother-in-law who's a bankruptcy expert. And I have some friends in other industries who have some bankruptcy and restructuring experience. And so I was literally spending half the day on the phone with my friends and my brother-in-law. Okay, how do I work through this issue? And I was learning. We had great real estate chops and the ability to understand value and what made sense and what didn't make sense and working through the restructurings. But there was a whole new art form called bankruptcy and restructuring that I never had any experience in. But I learned that beginning in 07. And so by the time 08 rolled around and it was, Morgan Stanley's turn to be involved in restructurings, for lack of a better word, of the underlying real estate investments as well as the firm, I had some experience. And, in the land of the blind, the one-eyed man is king. Nobody around me had any experience doing it because I had that advisory work. And I learned every single day. You invented all of this. You thought about, okay, how do I create a good bank, bad bank? How do you do that? How do you work through problems in funds when they're overcommitted? How do you address these topics that I had never addressed in my career? And really nobody had since the early 90s. Because it was really the RTC crisis. That was largely over by 93, 94. And so you're talking about a long period of time and therefore the expertise and people in the industry. But it was an amazing experience. Learned far more in those couple of years than I've learned in a decade of a bull market.
Can you pick like an example or two of a tangible restructuring that you worked on and like how it worked out? Like what happened? What was the problem?
Yeah,
and what was the outcome?
We had I'm gonna change the names to protect the innocent. We had a $2 billion residential land business that an investment manager had gotten one of the pension funds into, and a year and a half before it, and it was going to take $750 million at that point in time. The first point in time in order to save it. The investment manager was pounding the table. You need to invest this money. Remember, they just a year and change earlier convinced the pension fund, you need to do this. This is the greatest investment in sliced bread. You're going to make a fortune. And in a year and a half later, they're coming in saying, well, not only did that amount of money not get it done, we need another 750 just to survive. So the human dynamic, right?
Yeah.
The human dynamic on the investment manager side, the human dynamic on the pension side.
Yeah.
And so what they needed was someone like me, or not me, but someone like me who was going to be much more objective. And so the first thing I realized, this 750 isn't going to fix this thing.
Yeah.
It isn't going to come close to fixing this thing, right? All these assumptions are unrealistic. Now, I had that perspective because my firm at the time, we had a lot of experience in the residential space as an investor, in addition to a banker. So I was able to get a lot of insights and develop a point of view that they're just going to come back to you guys another year from now and need another $500 million. This thing is, already $1 billion underwater. And so the only solution is to put this thing into bankruptcy. Well, for the pension fund, from a PR perspective, to put this in bankruptcy, this was not an easy task. And so there was a lot of work to do in socializing, with the pension fund and their board that, look, the only right thing to do here is to put this into bankruptcy. It is not to nurse this. It's not to feed this. You should not put another good dollar after bad money. And so there was a lot of human dynamics involved in getting them to a simple analytical exercise. But because of the dynamics, the investment manager wasn't willing to say that. The investment manager was the fiduciary. Ultimately, this thing went into bankruptcy. It was bought up by all these hedge funds. I think pieces of it, dribbles of it are still out there, but it was a disaster. And I don't even think the hedge funds who bought into it cheap have done particularly well all these years later.
Did you say that some of that had to do with the PR around all this, like the perception?
The pension fund didn't want to put anything to bankruptcy. They didn't have any, they protect their brand and their reputation. This wasn't a commingled fund. This was their balance sheet. This was a separate account.
So I guess the next question is that a thing where like pensions will act out of what makes most business sense?
I think different institutions of all stripes, right? You need to consider the totality. I would never make a generic statement that pension funds in general do anything.
Yeah.
So I think you need to look at each investment manager and each pension fund and each institutional investor and understand the soft parts of their business as well as the pure, financial parts of their business.
So I'll ask you a loaded question then. For someone that's what are the soft questions to ask an institution or a pension different than what you'd ask a family office or a private investor? Like, what have you learned? Is there a common set of questions?
I don't think it's a specific set of questions. I think it's up to you to get to know your partner, your client, and understand them holistically. And that's intuition that you develop over a point of time versus, going in there with a checklist. Here's my 20 questions I'm going to ask you. I think you learn that by getting to know people as to what's important to them and what's not important to them. What do they value? What are their objectives, right? Not everybody's objective is to maximize the last IRR decimal point, right?
To be fair, though, at like institutions, a lot of times is the person that you meet and start the relationship with might not be working there. It's not their money. It's not they could not be there for 3 years. Sure. Is there a layer of due diligence that you can do beyond just knowing the person to know what that institution really cares about net of who's actually the relationships with?
Sure. And, given the internet now, there's everything from podcasts to to their own websites to look, and the older you get in the business, the more people you got friends, board members, you develop that understanding through understanding, if you're in any business, you really should understand your client, whatever your client means to you.
Yep.
How you figure that out, well, that's the art of business, right?
During 08, 09, was the common thread of all the distress just too much debt? Or was there a common theme you saw amongst everything, irrespective of asset class or geography, was like this was the crux of the issue? Or was it all different types of things?
For the most part, it was leverage, not entirely. Housing, residential was a secular, right? That was just a secular, 40% downdraft in asset values and oversupply and overbuilding. And I'd say that wasn't leverage per se. That was leverage, which led to excesses, right? Which compounded with leverage. I think in most of the other sectors was leverage. Some of it was cross-collateralization, leverage and cross-collateralizing things. So when one domino fell, it took down the whole house.
Yeah.
I think those were the two main things. I mean, look, we had a collapse of the global financial system.
Yep.
So liquidity was just pulled away from the marketplace. Even if you were moderately leveraged in the scheme of things, getting refinancing or new debt to do things. So it was a very different time than today. I mean,
you weren't on that team, but I had a gentleman on here probably 20 episodes ago that I can't remember what team, but he was on the mortgage-backed security team at Morgan Stanley that lost
$10 billion.
$10 billion.
Yeah. What's his name? I forget the guy's name.
Just being inside of a large company that has that going on.
Yeah.
Does that impact your team? Like, is stuff going on?
That was the firm's balance sheet. That was the principal trading part of the firm. It did come out of the mortgage group, but that was not out of a client part of the business. That was a balance sheet business. So we all kind of read the same press release a little bit in shock, like 10 billion, one trade. Wow. We work really hard around here to make $10 million. But it didn't. It was isolated from our world.
Was it looking back on those years, do you remember there being a time where you thought we're out of this, or was it in hindsight that you realized you were out of it?
It was in hindsight. It was, well, let me step back. That's not entirely true. This thing started from my perspective in 2007, right?
Yeah.
Now, when kind of Lehman fell and all of that happened in 2008, and that was just jaw-dropping. I mean, you just couldn't believe what was happening. And we were literally dazed. The firms were going down like dominoes, and we were next. Actually, Morgan Stanley was the next firm to go down before TARP came in.
Yeah.
You did realize in June of 2009 that China was going to bail the world out with liquidity. Like you could see it, right? By June of 2009, you were almost able, like I'd say, I was in the seat I was in and what we were dealing with. Like you're like, oh, okay, right? We've got this now major economy. It's got huge amounts of demand and liquidity, and it's going to start putting the marginal bid into the marketplace, and it's going to begin. But that started a process. And then remember, there was the Greek euro crisis in 2011. There was a break of the euro. It really didn't, from my perspective, it wasn't until like 2012, 2013 that you could look back. I think downturns happen really fast. And coming out of them, it takes place slowly and it looks rocky and it's uneven. And I think it's through hindsight that you recognize it. You might see catalysts in the global capital markets that give you the confidence that we're going to work out of this thing. But I think it's more in hindsight, and it's much more slower than downturns, which happen very quickly.
Okay, so this will be a theme. I'll just continue asking dumb questions. But if maybe I'm too young, or maybe I just haven't read enough on this, I just assumed the American government bailed everybody out. But this is the first time I've heard that China was the actual liquidity.
Well, the U.S. government with TARP, put the bazooka out that stabilized. There's no doubt that Paulson and what he did at that time, and the TARP program, that stabilized the market at a moment in time. But it was incredibly fragile. And of course, the United States is the world's biggest economy. But remember, China was growing by leaps and bounds at that point in time. And as you know, in the real estate markets, by the mid-teens, the marginal bid in the United States for real estate, for the best real estate and the biggest real estate deals was China. Undoubtedly, through 2015. I mean, they were the marginal investor across the United States.
Interesting. Okay, so when somebody's in a restructuring, obviously there's a lot of human stress. It's a negative situation. Nobody's really happy.
Yeah.
Trying to ask this question the right way. And we'll relate it to today's market. How often does like the first, I would assume it's kind of like something where you like kind of offer up a solution, but people always probably think there's a better solution. So they keep working down different tunnels. Like how often is it that you kind of end up back to where you should have started to begin with, where like you can make a restructuring much easier by not trying to play this game of let's go to the last mile to make the best deal, when the best deal is usually obvious from the very get-go?
I think almost all the time, because, like real estate deals are done on relationships and trust. The moment you get into restructuring and foreclosures and bankruptcy, that's all out the window. It's all contracts.
Yeah.
And it's everybody leveraging their position. It's the lawyers coming in and everybody fighting over their relative position because, the pie is shrunk and there's fewer crumbs to go around. Now, the equity guy might realize, okay, I'm out, please take this from me. I've had enough. But he or she is going to fight for a while, right? They're going to fight to preserve the optionality. Then it's now the fight amongst the various creditors, unless there's just one creditor. And they're going to fight. And it's a process.
So if there's multiple creditors, they'll fight just to see who's getting paid first.
I mean, it depends upon the size of the deal. If it's one bank taking down, maybe there's some tussling between the equity and the bank. But I think multi-party transactions, do you ever try and get a deal done amongst three or more parties in the good times?
Yeah.
Imagine having to deal with three or more parties in the bad times.
Yep.
Yeah.
So if you had to sum it all up and say the best advice for someone that's going to go into a restructuring, what is the three-step playbook? Okay, know your rights. So have a good lawyer.
Know your rights
before you even start the restructuring process.
Well, no. If you look before you start the restructuring process, your capital partners, you're still partners, and you should try your best, right, to be as honorable as you can and work out a bad situation as partners, and hopefully everybody will participate in that. Yep. Now, if you're the equity tranche in that deal and you're not willing to put any more skin in the game, you're going to get wiped out pretty fast. And you're going to go from being partners to being on the outside looking in. So the first thing is, before anything starts, is be good, honorable partners and try and do the right thing and try and work cooperatively together. But at some point, if that breaks down, then have your lawyers and know your rights and understand your documents and understand your positions and understand the dynamics. A bank, I'm picking on a bank here. A bank may be the lender, you're negotiating with them, but in the documents, they might have the right to transfer the loan, and you can wake up the next day and it's owned by some hedge fund. And that hedge fund has a very different objective, right, than the bank did. So understand that loan may be going elsewhere. And even if the loan officer you're working with is your good pal and you've been there a long time, he or she can wake up and find out that it's gone. And so understand that relationships really begin to leave the room, and understanding all the dynamics around the underlying deal and your rights is really the critical path.
And you ended up staying at Morgan till 2016. Did your job change in those years after 08 and 09, or were you kind of were you in a restructuring phase for 6 or 7 years?
No. We like I said, by June of 2009, the damage had been done, but it was like, okay, we're going to get, it was clear. It's like, we're going to get to the other side of this.
Yeah.
You need to understand, in the fall of 08, you didn't know if you were going to get to the other side of it. You didn't know if you'd had a U.S. banking system. Everybody was getting wiped out. And so there was just jaw-dropping fear going on.
Yeah.
But by the summer of 09, it was like, okay, the sun's going to rise and the sun's going to set and the markets are going to move forward. I would say that the real estate investment business at the firm, by the spring of 2010, was kind of moving beyond pure defense and had moved back into some degree of offense.
Yep.
And some things were now working out really, really well. And by 2011, the real estate investment business now was kind of rebuilding itself into the next chapter. And then at that point in time, I moved from the real estate group across illiquid alternatives. So the real estate group is part of other asset classes such as infrastructure, private equity, private credit, venture capital, and it's kind of part of that group. And so then I took responsibilities across illiquid alternatives for a couple of years, and then I took responsibilities across liquid, traditional asset management, equities and fixed income investment management. So I was responsible for that business for a period of time. And then people changed above me. The businesses got merged into one business. And then in my last responsibility was across illiquids and liquids. I was COO and head of distribution for the combined business. So I had a bunch of different experiences.
Okay, a couple more questions on just this period of time. What were the worst asset classes?
I appreciate the questions. It isn't that interesting, but go ahead.
It is interesting.
All right. Okay. All right.
What were the worst types of assets to be in at that time? Non-rentable
hotels and land.
Yeah.
Yeah.
And is that a theme amongst every down cycle, or it's just different every time?
Look, levered land is a dangerous place to be in a downturn. Yeah. On the up and look, in an up cycle, it's great, right? But in a down cycle, it's a particularly. So what did I learn from those experiences? If you're going to buy land, if you have the capacity, don't put any debt on it.
Yeah.
And so I think it's a pretty common phase. People during a downturn who use leverage to buy land, wind up generally in a bad place unless they have liquidity elsewhere. Hotels are just incredibly volatile, and we could spend hours on the hotel business. They're just incredibly volatile.
Why?
There's two fundamental reasons. One, it's an operating business dependent upon the vagaries of the customers who come in and out every night. And so if you have during 9/11, right, when the Twin Towers fell, people stopped traveling. When they stopped traveling, they stopped going to a hotel. Yeah. COVID happens. You know what people do? They stop going to a hotel. Business turns down hard. Every corporation in America starts cutting its travel budgets. So if it's not one thing, it's another thing that creates the volatility of the underlying customer. As it relates to the asset class hotels, so here you are owning the real estate. You take all the risk, all the capital risk, and here's all the other participants who are feeding off the top line, right? You have a manager of the hotel that's probably not you, and they're feeding off the top line. You have a brand that's feeding off the top line. You have a distribution system that might include Expedia or something like that that's feeding off the top line. You have supply coming online through VRBO and Airbnb. That's a more modern phenomenon. And then finally, you have the brands who are cannibalizing you at every turn with the next new brand such that your radius restrictions don't matter. And so you have a lot of forces at work, a lot of headwinds at work that aren't making your life any easier as the owner of the underlying real estate. And you can study this as an asset class on a risk-adjusted basis over time. It's very poor returns. You can study the hotel REITs and you can look at the amount of CapEx. I mean, the last thing, which is in volatility, for volatility's sake, the industry lies to itself with respect to the amount of capital that's necessary to maintain these assets. Yeah. And so if you're in the hotel business, you're going to see in people's underwriting a 4% of revenue FF&E reserve. I don't know anybody who's owned a hotel over a long period of time who's only spent 4% of revenue on FF&E. Yeah. And so there's all these forces at work that don't yield, a better than average risk-adjusted return for the asset class. In my perspective, and I debate and discuss this with people all the time, but for a period of time, I was responsible for lodging at Morgan Stanley globally. And I guess I formed a point of view through those years.
So I'm going to say, spoiler alert, Crow is probably not in the hotel business.
We, Trammell built a very large hotel that we own today at the company. And we own another hotel, a very lovely high-end boutique hotel, but those are all on the balance sheet of the firm. Yeah. And those are parts of our history of our firm. I mean, you may not remember this, but we did have a huge hotel history. We formed Wyndham Hotels, took it public, So there's great hotel DNA at the firm. But today, of 600 plus properties we have in our investment and development business, there are no hotels.
Okay. All right. So you have been at Morgan Stanley for a while. How did you meet Harlan? What was that first? Was it by chance or was there?
No. He had brought on a recruiter because he had decided that he was going to retire and wanted to look outside the firm for someone with a different background. And so we met through that in the fall of 2014. Footnote, and I had no relationship with the Crow organization at all those years, except one of the very first transactions I worked on in 1994, I think, maybe early 95, at Prudential Securities, was the recap of an industrial venture that the Crow Holdings and Harlan at the time. So one of the first deals I worked on was related to Crow, and then I didn't touch the organization for 20-something years. So it's just the small world that it is.
And you can brag about yourself, or you could just say it however you want to say it. By the end of Morgan Stanley, what were you great at? What were you known for at that point? What was your kind of expertise?
God, that's a question you should ask other people. Look, I think I basically, treated people throughout my whole career fairly and with dignity and respect, and worked hard to build relationships. I mean, I think I worked very hard. I mean, I know people talk about hard work and but when I say when people talk about doing all-nighters, growing up in that environment at that time, we literally, early in my career, you do 20, 30, 40 all-nighters, 50 all-nighters in a year. I mean, you literally worked 100 plus hours a week. And I felt privileged and lucky to be in this job. So I worked as hard as I possibly could do. Was my quantitative analytical skills better than anybody else's? Probably not, but as good as anybody else's? Sure. But going to law school taught me how to communicate, how to articulate my point of view, how to analyze a situation, in writing in particular. The ability to communicate your ideas and your thoughts is a critical element for any of us as business people. And I think that experience I had going to law school, learning how to do that, learning how to get your point across crisply and articulately and clearly to the other side, is probably something that I did well. So I don't think there's any one thing. Yeah. I don't think somebody would say, Levy was best at this. I just think it's like, okay, I did all these things and I did them well enough that it just carried me through.
And you've said this, we talked about it at lunch, but I've heard you say it before. You've said, I'm a man of commerce. What does that actually mean?
Look, when I wake up, there are a lot of distracting things that you as a business person could decide to get involved in, particularly what we've seen, the past few years. And I have my own civic, personal, but when it comes to business, I'm just focused on driving the business forward, creating growth, creating opportunity, for the people that work around me, with me, for our clients. And that's just the way my brain works. Charles Dickens wrote A Tale of Two Cities. And in that book, there was, I forget his name, but he was the intermediary in the book for throughout it. And his point was, I'm business, all business, when anybody would come to him trying to move the discussion into other topics. And I just don't spend my time there from a business perspective. What difference does it make? I'm here to help execute or help foster ideas around growing the opportunity and delivering the results for our clients, for the people that work for us, and ultimately for the firm. And that's where I want to spend my time and attention, not all the noise, that's permeating the business world today.
Michael, I love you. Okay, so you meet in 2014, but you don't actually take the job till 2016. So y'all obviously, I'm assuming there was about a year-long talk, or did this build over time? Go from like first meeting to like what happened.
God, you're getting really detailed, man.
Well, come on, I told you this would be fun.
All right, okay.
It's fine. These are huge things. These are awesome things. Yeah. These are reshaping the real estate world things.
I know. I get it.
So that
at some point we'll talk business and not Michael.
We will.
Look, we had a terrific first meeting, and it was great. I mean, I came down. I'd been coming to Dallas my whole career, but this. Your listeners may not know this. So I drive up to Old Parkland, our office campus, and I was just blown away. I was like, "What kind of place is this?" And then I met Harlan, and he was just such a thoughtful, benevolent, considerate human being, which is I didn't know what to expect. I was like, "Wow, that's phenomenal." So I had this wonderful onboarding, for lack of a better word, in terms of the first discussions that we had. And that went on great for 6 months. And we were moving to a point. It was clear on my side and clear on their side that like this was going to come together. And it's now April of 2015, and I'm on vacation in the Caribbean with my wife and kids. And it's a Thursday. And of course, I'm thinking about this. My wife and I am like, this is Texas, honey. This isn't New York. Like, this is a big step. And we're getting emotionally, prepared for this. And on a Thursday, I get a phone call from the number 2 guy at Morgan Stanley. He doesn't call me regularly. I'm not like his best pal. And he calls me to tell me they're going to restructure the business, and I have an opportunity to run, this part of the business, and this is your shot, and take your time, but let us know by Monday morning because we'd like to announce it. Oh. And it was a great opportunity. It really was. It was a tremendous job. I mean, it was a great experience. And I knew right away that I needed to go do that because Harlan, we weren't done. Like, we didn't have a handshake. We were still meeting one another, and I couldn't pass on this opportunity. So I did that and took my hat out of the ring, and I took that new opportunity at the firm, and it was really cool. I learned so much. And Harlan had continued. Harlan and his team, and Ann Raymond, who's she and Harlan ran the business. Wonderful, wonderful people. And they kept looking and talking to people, and a year later, I was sitting there in the middle of the day, and Ann called me up, and she was like, "What are you doing? How you doing? How's your job?" And I guess I had in that year gotten closer to the wick of the flame, and it just was less interesting to me. And I guess I always thought about the road never traveled. I didn't go through that experience and never think about the situation. And so when she called me back, I was like, I'd love to talk again. So we very quickly picked things up. The summer of 2016, my wife and I came down. We spent a couple of days with the family, with the business, with the board. We kind of hung around, and we looked at each other and like, we got to go do this, man. And then I left. I think in a matter of weeks, I resigned, and I had 4 months off between gigs, which was fabulous. I mean, garden leave is great. It's if you know what you're going to next, you have no anxiety about the next chapter in your career, right?
Yeah.
So when in your life do you have months that you don't have to worry about your email and you don't have to worry about phone calls? And so I had 4 months with my kids and my life, and then I started in November of 16.
And I know the answer to this, but I have to ask you anyway.
Okay.
So you were the first person outside of the Crow family to actually lead this business unit, or the Crow.
Yeah, I mean, there's been incredible leaders who've run, incredibly large businesses, but kind of at the holding company level, it was Trammell and there was Harlan, and then I've been in that seat. Yeah.
So was there any additional pressure? Like, did you feel any extra, like, I have a target on my back? Or was it by that point you had built such a great relationship knowing what you're getting into that?
No, I didn't feel like a target, but I mean, I definitely felt like, don't screw this up.
Yeah.
I mean, I was like, the weight of that. I mean, look,
yeah.
Those of us in the real estate business, the Crow history, the Crow alumni, the ethos, the brand, the culture. I mean, this is one of the most storied, important real estate organizations the United States has ever seen. We may not be the largest, we're not black, I got it, but what matters here and the integrity of this brand and the impact we've had on people. So to be shouldered with the responsibility to, okay, let's see what you can do in this next chapter was the feeling was, I should not screw this up. Like, work really hard. Don't screw this thing up. So that's the feeling that I had at the time.
Well, you kind of already gave the answer. What was your 1-year plan upon arrival?
That was it.
Don't screw this up.
Yeah. I mean, no, look, I understood the nature of the business. The only thing I could say to you in the business plan was I saw this company whose brand and ethos was so large across America and outside of America, but the scale of the business and the businesses, the different activity was relatively small compared to the actual size of the brand. And I figured to myself, how often in your life are you going to be given the opportunity to try and fill a little bit of that gap? Exactly how? I had no specific idea at the time. And I think, look, if Harlan was sitting right here, he would say to you, surely my background and experience, all those things were very relevant, looking for someone who had more of a Wall Street background than a Main Street background, perhaps for lack of a better word. But for him, he had a sense culturally that I'd be a great fit.
Yeah.
And on paper, it makes no sense.
Why?
Yeah. Well, I'm New York, Brooklyn, family's from Brooklyn, went to Brooklyn Law School, worked on Wall Street, kind of scrappy, Jewish guy, and I'm going to come down here to Dallas, Texas to be responsible for Crow Holdings. Like, it's not the thing on a piece of paper that you say, oh yeah, that's a perfect fit. But it just goes to show you that don't judge a book by its cover, and culture is culture and people are people. And so I think that was what it was more about.
Okay, we're about to get into business. You're a proud New Yorker. You've been there a long time. You've been in Texas for 8 years.
Yeah.
The largest listener demographic of this podcast is in Texas, but the second largest is actually in New York. What is the difference between a New Yorker and a Texan?
Let me say it in kind of attributes that I immediately saw when I came down and when I knew. First of all, there is just this hospitality element down here in Dallas. Dallas is effectively formed by 2 railroads crossing in a place that people didn't necessarily want to move to. And so you had to invite people in and welcome them. And it's a welcoming, hospitable environment. And that's really nice. And it's not that New Yorkers at all are jerks. They're just busy and they're rushed and they're direct. It's a different thing, but it's nice. The hospitality, like, who doesn't like that? Who doesn't like to be welcomed? And I don't mean just because of the job. I remember going into the Department of Motor Vehicles to get my driver's license. And the guy on line next to me hears I'm moving to town, and he couldn't have been nicer and genuinely wanted to help me. And I think that's in the culture of Texas more broadly. And it's very attractive and very appealing. And I would encourage anybody who hasn't spent time here to get to know people, because it's genuine. It's not like in New York, you might worry, they're being a little too nice to me. What do they want from me? I think in Texas, it just comes, people generally have that. I also see, and America sees this very clearly, Texas in general, it's focused not only on thinking big, but priding themselves on ambition. It's okay to want to be ambitious and to grow and to be business focused and create opportunity. It's in the lifeblood of the state. It's in the local governments of the state. It's in the state government. It's a place that honors commerce. And as a person who's focused on that, who doesn't want to be around that?
Yep.
So those two things together are just incredibly attractive and very different than New York. It's not that there aren't New Yorkers and business people who are interested in commerce, but we all see that certainly the political apparatus, around New York City and New York State had turned wildly, and it really started in earnest around the GFC.
Yep.
So it's lost that edge. When you have Congress people like AOC, priding themselves on kicking Amazon out, like, what does that tell the next business versus a city like Dallas that is a sucking sound of inviting these companies in and providing a quality of life to the people that live here. And those are the two biggest things. There are things about Texas and Dallas, just growing up there, like it's really hard to get good Italian food. Like it's really hard to get good Greek food. These summers are really hot. They're really hot. Yeah. And but those are kind of, those are quality of life things for some people, but they have really very little to do with the seat that I sit in, in terms of running the business. But I would also tell you, last piece, I'd say this in general, let's just say Texans, they're not as direct because they're so hospitable and welcoming. They're not as direct.
Yeah.
And in New York, people are very direct. And being direct helps you sometimes really get to the heart of things quickly, and you can get things done. And so being indirect it's nicer, but it isn't always the most efficient or effective way, to resolve differences and resolve conflicts and move on with the business. And so there's elements of that. And the other point, notwithstanding what anybody thinks about New York City, the energy on the ground, the amount of innovation that comes out of that market, the global crossroads that it is for investors and operators, there's just no place like it. I go to New York, I spend a day there. The amount of ideas I come back with and relationships I connect with, it takes me a lot longer period of time here. And so there are attributes of that city that are very valuable, certainly if you're a national real estate company with international investors.
Yep. Okay. Can you talk about the business that you run today? There's 4 pillars of it. Like, what are you in charge of?
So Crow Holdings has 4 business units, for lack of a better word. One is, coming out of the S&L crisis, Harlan started to invest in securities outside of real estate because never again would we one asset class. And so today there is a securities investment business for ourselves as well as other families that has nothing to do with real estate. The second business is a large national real estate development company. We have 20 odd offices from coast to coast. We're one of the largest developers of multifamily and industrial. We have a small office development business that we started effectively during COVID. And it's a fabulous business. And that's the business that started it all, in 1948, the industrial development business. Coming out of the S&L crisis in the late 90s, Harlan and team started a real estate private equity fund. Today, it's a multi-capability real estate investment management business. So that's the third business line. And then the fourth is something that we started more recently, is an energy business, where we both have a traditional energy business in the oil and gas space, and we have a solar business, a community solar business. And the energy business is something that's obviously much more nascent. It's hands-on, and we're trying to grow that right now.
Okay, when we were talking at lunch, you told me about the capital structure, or how you raise capital. I believe it was for the development business. And it was the most unique structure I've ever heard. Can you explain to me how that works?
Sure. So context rather than some.
Yeah.
So we have a multifamily development business.
Yeah.
We're in any given year, we might start 5,000 to 10,000 apartment units across the United States. And we have an industrial development business where in any given year, we'll start 5 to 15 plus million square feet across the United States. And so they're scaled businesses. And you need capital, right, for that business. And so in light of that scale, we thought about, we've been doing this for a long time, we had for 70 odd years had a business that raised capital to build a building. And then once we built the building, we sold the building with a capital partner. And they would exit and we would exit. There was no build to hold. It was all build to sell. And it seemed that institutional investors had more and more of an appetite for build to hold.
Yeah.
Right? Rather than go and buy this core asset in the marketplace, why don't I build it at 150 basis point higher yield on cost, and I'll hold it for the long term? And so there was an opportunity that was already happening in the marketplace for our development company to get into this build to hold business. But given the scale of the business, there was no single investor that was going to be able to meet the needs of the business, as well as even if there was a single investor large enough, they're going to pass on all sorts of things that we do because they may not want exposure here or exposure there, or they have liquidity challenges. And so we thought long and hard, how do we partner with investors on some type of build to hold structure. And that led to, okay, well, if we give one investor a ROFR, right of first refusal over our business, that could really gum up the works over time, because the scale of our business, there is no investor in the world that has the equity capital. I mean, they technically do, but they won't deploy it through cycles. And that led us to think about, well, given the scale of the business, we can actually take our pipeline and break it down into slots, for lack of a better word. And so we were able to, in the industrial business and the multifamily business, break the pipeline down into 5 slots. Now, it is a blind pipeline, meaning any new deal that comes in that lands up as a formal pursuit in our business, as a fiduciary, we're managing that pipeline. And so there's no cherry picking of our pipeline in those rotational slots. And so we now engage with investors to say, if you're interested in a build to hold relationship with us, you'll have a right of first refusal with respect to 1/5 of our industrial development business or a multifamily development business. And that is an option for you. You'll have preferential access, and all the economics will have been pre-negotiated. So as a developer, and once the building is built and stabilized, ultimately over the long term, and as an asset manager for that asset, all of that structure, negotiating terms has been negotiated up front. So it's a very efficient business model. It gives the institutional investors continued discretion with respect to our business and our activity. But we now have multiple relationships. We also don't have to commit each of these slots to a given investor. And so we have amazing, terrific partners who want to do one-off JVs with us from time to time or on a regular basis. And so some of these pipeline slots, we have committed capital partner relationships with, or funds that we manage with respect to those slots. And several of those slots we intentionally leave open so that we can opportunistically go to the market and continue to do business with people who've done business with us for long periods of time on a build to sell basis. And it's worked out incredibly well. And we started that in 2020, I think. Like, the idea came up, and it's now those programmatic build to hold partnerships, funds, that's probably half of our business, give or take.
Not to get too nuanced, but if the business grew and let's say you were consuming like $3 billion a year instead of $1.5 billion, is the goal to keep the same amount of slots, just increase the amount in each slot, or just maybe open up more
I think
slots?
we'd address, look, the development business is incredibly cyclical. Right now, we're not starting at those levels. So there's less in the slots. You know what's happening at the same time? Our investment partners want to do less at this point in time. So it throttles nicely at the moment in time. I guess let that be our problem, right? That we've gotten to that scale, and maybe 5 should be 6. Although you can't change it because you've committed to these folks. You can't just change it on a dime. So you've got to be comfortable. And we put a lot of thought into, what is the right number of slots? How much capital is needed? What are investors looking to do? I don't think there's any perfect science here. We thought about other rotational systems like, in industrial, we could do last mile versus bulk distribution. We could do regional. There are lots of different ways that we could cut up our pipeline. But what investors are most focused on, the concerns about cherry picking. They want to make sure, and we're concerned about it too, right? We don't want any of that impression. So we just decided that a blind pipeline, run on a rotational basis where, look, for a while, maybe you're not interested in what we're putting in front of you, but at some point you're going to be interested. And obviously investors diligence us. They know exactly the markets we operate in, the kinds of buildings we build. They know the character of our guys in the field. And it's worked out really well. And when you say blind pool, I'm just making up It's not blind pool. It's not a pool. It's a blind rotational structure.
Correct. So they could see a development deal in Atlanta, and by the time it comes back around, the next one in the hopper is a development deal in Charlotte.
Absolutely.
Yep.
Absolutely. And so if you were an institutional investor who said, I've got X $100 million and I want to deploy it all in Texas and Florida, this structure may not work. You may not see enough. That being said, we have a lot going on in Florida, a lot going on in Texas, but you know what I'm saying? If you're a real sharpshooter as an investor and you want very bespoke exposure to a given market, this structure may not work for you, in which case we still have these open slots. And so if we have a relationship with you, sooner or later, something's going to, come by that we're able to, have a relationship with you on.
Okay. And then on the real estate investment management business, which is similar to private equity, that's where developers all over the country say, I have a deal and you are a financial partner, whether that's equity, debt, or some combination of both.
That's correct. Now, that business isn't all development, but absolutely a core part of that business, particularly in the multifamily and industrial space, is providing equity capital and debt capital to other multifamily and industrial developers across the United States. And that we've been doing it that way for 20 odd years. People when they first hear it, they're like, is there a conflict that's built in there? There's no conflict that's built in there. What's potentially built in there is competition.
Yeah.
We've got these development companies who are competing with these other development companies we're financing. But the reality is our development company is sourcing land. By the time we're providing capital to you, the third party developer, you've won the land. Yeah. You're now building the building. And so our real estate investment management business comes in later than our development company. And, in the 7.5 years, we've never had a problem that between these two parts of the house bumping into each other or creating conflicts or reputational issues. We pay attention to this and we recognize our business models. So far, so good.
Okay. The headline number was like $3 billion, was a recent fund, but the one headline behind that, I think it was like $1 billion for neighborhood retail.
These are press releases you're hiding. We in the real estate investment management business, we have a number of different capabilities, whether it's through funds or through joint ventures with institutions and individuals as well. But and so we have a value add capability that goes back 25 years, and that's a closed end. You would call that's the closest thing to private equity. So we have a value add private equity fund, and what you read on the press release was $3.1 billion and $600 million to co-invest. We have a secondaries or liquidity solutions business that's a club deal amongst a bunch of investors. We have a credit, mezzanine lending business that's a joint venture amongst a handful of investors. We're working on the core plus space right now. The retail, so those are 4 things. The retail we've been doing on a bespoke basis, meaning outside of the private equity fund since 2015. So we had raised some prior funds in 2015 and 2017, some closed-end funds around that small retail business. Those funds had fully invested their capital. We were looking for, okay, what's the next step? And a very large global investor came in and said, we'd be interested in acquiring all of these assets and forming a new joint venture with you to grow this. We did give the investors in the old funds an opportunity to continue to participate in the growth, but we effectively recapitalized some historical funds, in a joint venture format. And that team now is out continuing to invest in these really small food and service retail properties. So that would be the 5, different capabilities of our investment management business.
Okay, let's just talk about the market now. And one of the quotes I love.
This is the fun part.
This is the fun part. I knew you've just been chomping at the bit. I had to, we can.
I know you had to go through that. I got it.
But something you're pretty, again, if you listen, this is not something that I made up, but you've been pretty great about saying this. I think it's awesome is you've said like we all seek certainty. And that basically your all the data and what you've seen over this long career is that the highest paid people that predict the future are basically wrong.
Yeah, sure. No doubt.
Okay. So knowing that, how do you step in to view markets?
Look, within all that, we all operate for some baseline, right? If I thought that, the sky was going to fall tomorrow, like you'd behave differently. So in general, I'm imagining a future that's largely consistent with the past over long periods of time. America will grow. We will have GDP growth. We will have population growth. Inflation will be under control. I operate from that general baseline. And I don't from there then try and predict where interest rates may go next year. The question is, in that baseline and with asset prices and capital markets, does the deal make sense or not today? Obviously, you have to say, well, if I think cap rates, you have to bake in assumptions. But if you assume the world's largely going to remain intact, if you're doing deals where a 25 basis point move in the terminal cap rate is the difference between success and failure, do not do that deal. Try and find ways to add value to the real estate that you're not so dependent on a small move in the capital markets or the cap rate. And that's how I think. And the more I listen to people talk to me about I just check this stuff off. I have 25 years, 30 years of a history of listening to people. And so what makes me think I can guess better than they? And so I work really hard to think about what are secular trends that are going to transcend this. And, they're obvious, right? I mean, not all of them are obvious, but they're obvious. Are people going to move to the Southeast and Southwest continuing? Are they going to flood? New York City's lost, notwithstanding how much I love New York, 500,000 people since 2020. Are all of them going to roll back up and move back in? No. Where are they going to move to? They're going to move to the Southeast and Southwest.
Yep.
And we can go into each one of these. We can look at housing and demographics and affordability. We can look at, the demand for electricity. There are things, and what's that going to mean? There's obviously an obsolescence curve. We can see what's taking place in the office sector. So maybe we'll get into some of the details, but I try and focus on, and I use the word we, right? This is deep in our culture, right? After 75 years, right? Really focus on these secular trends, and then watch your leverage, right? And make sure you have the liquidity to get to the other side, because you might get whipsawed by an economic cycle that occurs when you least expect it, right? And the way you're going to lose is lose the asset in a downturn. The way you're going to win is hold on to it through that downturn. Even if you went to America and you paid top dollar for assets in 2007, if you could hold on to those things to 2013, you got your bait back. And if you waited to 2016, you got a decent single-digit IRR. So it's all about getting to the other side for most things. And then sometimes you have a secular change like office where it's like, oop, well, that one caught me off guard.
Yeah.
So.
Okay, we're going to talk about a lot of secular trends. But before we do that, just start with 2024 versus 2008. We're in two real estate downturns, but you've already said once, like, these are different. How is this one different? I won't ask you to tell the future of maybe where we are in the cycle, or maybe I might, and you can tell me you don't know, but how are things different right now?
Well, the first thing, so what happens in 2008, and residential had its own thing. There was obviously for a moment in time, a complete collapse of liquidity, but when liquidity started to come back, interest rates had fallen to zero. So you thought you weren't going to get to the other side, but all of a sudden your financing costs are 2.5% and 3%. And you're like, oh, I'm going to get to the other side of this thing. And so the really, really low interest rates that carried all the way through until 2 years ago, that really helped the real estate industry a lot. And I know everybody today talks about higher for longer, but I assure you, up until 2020, it was lower for longer, right? And so that became the baseline. So that low interest rate, really made a difference. Today, so yes, the biggest difference is the interest rate differential. Today, clearly, we're at a very different interest rate environment, and that's not going to carry you through. But equally, we haven't had the collapse in the underlying economy. We have strength in the underlying economy. So there are just differences. And then you can go through supply, right? The availability of supply in certain markets. And we have less excess supply now than we had then in certain asset classes. So there's just a multitude of differences. But the biggest one is this interest rate differential. And this high interest rates, this obviously gives people a lot of concern because they're like, how am I going to get out of this thing, right? Am I ever going to get out of this thing? I mean, we will see what happens with respect to inflation. And that will drive, but that's the big difference.
Okay, I told you I wouldn't ask you to predict the future.
Yep.
But I just have to ask.
That's
like,
okay.
You have to have an opinion on this.
I mean, I can't.
Are interest rates going up more? Are we going to see a cut? Like, how is
the data?
How are you? What's your baseline for this? Like we're just going to hold still for the next few years, or
what I believe, at least at this moment in time, is that the Fed is largely independent of the fiscal activities of the U.S. government, and the Fed is going to work as hard as it can to meet these dual mandates of full employment and low inflation. And they have said repeatedly that they're going to get this thing down from an interest rate perspective down to 2%, baseline inflation. And I believe the Fed when they say that. Now, what's going on right now in the United States, the reason they haven't accomplished that is because they have their foot on the brake and the federal government, right, has their foot on the gas. I mean, we're going to run a $2 trillion deficit this year again, right? And so the Fed's unable to achieve it as quickly but you see the data. And while it's sticky, inflation is coming down. And as it comes down, and if you just study, 10 prior cycles, the Fed's not going to keep the short-term rate at 5, right? It's going to begin to cut at some point in time. We're going to get away from this inverted yield curve. If we have a treasury at 4% or 4.5% or 3.5%, and therefore we have long debt at 5.5%, that is historically average. There's nothing wrong with that. And if we have the short end of the curve at 2% or 1%, we can borrow at 3 or 4 on the short end. I think that's the environment that we're going into, over the next couple of years. And that would reflect how we're investing today. Could I be wrong? Of course I could be wrong.
But you don't really think it's going up more?
I don't see the data that tells me that.
Okay.
And I don't think the data is out there that tells you that. And I think data is starting to tell you other things. The consumer is beginning to crack in the United States, right? Yeah. This inflation has really gotten to the point. It's not the persistency of the inflation. It's just a nominal price of goods. I literally, this past weekend with my son, I went to Whole Foods, 2 bags. Now, granted, there were some steaks and 2 bags, $242.
Yep.
Right? So the consumer's beginning to crack. That's not healthy. This $2 trillion, I just think the fiscal deficits are something that sooner or later our federal government will actually begin to deal with, right? And I just think there are a lot of forces at work that are going to retard growth, right, as opposed to accelerate growth. And that's on a global basis. And so I don't see the long-term systemic underlying global demographic and other forces to drive global inflation. People will argue with me and they say, well, the U.S. has got to monetize themselves out of this debt and the only way is to get out of it through inflation. And that's one argument against that point I made. But I believe that we will get inflation under some degree of control and interest rates will reflect that.
Do you even think about election cycles?
Of course. All the time.
Okay. So how do you think about them besides, red versus blue? How do you think about that from a capital allocation standpoint?
I'm not sure there's a lot of correlation between red versus blue winning and the success or failure or the success or challenges of the real estate industry.
So then what do you think about?
I think, look, there's no doubt in general historically that the Republican Party has been more pro-business, right? And has relaxed regulations and taxes and other things that are good for us. And so as a business person, that appeals to me. In general, over time, the Democratic Party, right, has delivered regulations and taxes. Right now, I'm upset with both parties, not for the reasons that you might think, but they have no fiscal discipline, either one of them, right? And that bothers me as an American. And you have 3 young children. I have 3 children. I mean, what are we doing to our kids?
Yep.
And neither party. So right now, I'm boycotting both of them.
Okay. But you're investing the same. You're not letting it impact the way you allocate capital.
I think in general in the marketplace, one of the things that's keeping volume slow is not only interest rates, it's uncertainty. And, global investors around the world are worried about what is this election, what's going to happen, which party's going to win, what's it going to mean. And so volume is down now as we are 6 months out or 5, whatever we're out from the election. I think volumes will be muted because the uncertainty will reduce the propensity to pull the trigger and people are going to want to wait and see.
Yeah. Well, can we talk about oil and gas for a second then?
Sure.
One of the reasons you're kind of bullish, maybe it's political, maybe it's not, is the economic fallout of interest in this energy source. What's your thought around oil and gas?
It's not political at all. Much earlier in my career, I had watched the tobacco industry get boycotted for non-economic reasons by investors. I watched that. I watched investors pull out and we're not going to support this industry. And then I watched the actual returns to the people who stayed in the industry. And it's just simple supply and demand. And I think what's happened in the traditional, the oil and gas, fossil fuel business is that a lot of market participants have exited for non-economic reasons. Some of them maybe because of bad returns. Remember from 2014 up until a couple of years ago, it was tough sledding. But I think a lot of them have exited, the large private equity firms. They literally have exited the business. Large institutions all over the world have said, I'm not going to invest in this sector. And that's created opportunity, less supply of capital. I mean, I think you're kidding yourself if you think over the foreseeable future, America is going to need less energy. And we'll talk about other forms of energy, and people are talking about small nuclear and other things, and they're all great and they're going to come online. But there's going to continue to be sustained and growing demand, right, for this sector for the coming years. And the supply of capital is clearly down significantly. And so from a financial return perspective, it's obvious to me from a return perspective, this is a good place to be.
Yep.
And we're also, look, we're a Dallas, Texas-based firm. Our network, our relationships, our access, the people that are down here, this is a great place to be. Maybe if I was in New York, I would think differently because of that. But we have a competitive edge,
yep.
In that. And that's what's driven our activity there. It's a business that I'm unlike our real estate business, I'm not, we're not engaged with institutional investors in that business because I think institutional investors are focused on the points I made earlier.
Yeah.
But for us as a company, for ourselves, and for our team, I think it's a terrific opportunity. Time will tell whether it is or not. We're newish into this business.
The most bifurcated market in my career is office and urban cores versus everything else.
Absolutely.
Okay.
Absolutely.
What's that mean?
So the headlines in real estate are terrible, aren't they? I mean, gosh, you pick up the paper and it's like you would think the sky is falling on the real estate sector across the United States. But that's not true at all. The sector that is just shattered is the office sector. A third of the buildings in America are dirt. I mean, they really are. They just don't know it yet, but they're going to be land that gets redeveloped. I mean, it's happening, right? It's going to happen. It's going to take 30 years, and then just call it the midsection. It's going to be there. It's going to be okay. Its costs are going to go up. Its tenant improvement cost and its dollars. The best buildings are going to be fully leased, fully occupied. You and I were talking earlier, people want to work in nice spaces. And companies realize in this post-COVID era to get your employees to come back, you need nice spaces. And so the best buildings will be fully leased and fully occupied. But a huge portion of the office market, what's happened as well is even in New York and other cities, people don't go back in general 5 days a week. I mean, some people go back, but you'll hear in New York, you'll hear people talk about Monday's kind of a half day, Tuesday's a full day, Wednesday's a full day, Thursday's a full day, and Friday's a ghost town. So you went from 5 days a week to 3.5 days a week, right? You've lost whatever that is as a percentage of people coming and going. What do you think that does to your urban core downtown areas? It decimates them. Retails get decimated, restaurants get decimated, property tax comes down because the value of the assets come down. And that's the fundamentals, let alone the capital flows. I mean, go around the world and try and find, equity investors and lenders who are bullish on the asset class. Now, right now, there is a little bit of hunting going on. There are places like San Francisco where families and others have stepped in and said, I'm going to buy that asset at a 60, 70, 80% discount to where it was just a few years ago. There are some folks across the country, trying to pull off some conversions of office buildings. But in general, this is a very, very long-term restructuring, recapitalization of this industry that's going to make the mall sector look small. This happened in the mall sector for other reasons, right? The mall sector in 2004 was the belle of the ball. I mean, it was the lowest cap rate, the stickiest asset class. If you get your hands on a mall, it was the greatest thing since sliced bread. There are 1,100 super regional malls in the United States. When the dust settles, there's going to be 300 or 400 of them.
Yep.
Right? It's just going to take 25 years.
Yep.
Right. The office sector is a little different. You'll continue to have, look, the offices aren't dead. People are going to continue to go in, but they want something different. So there's a huge amount of our stock that's going to get destroyed. And then over time, they'll get, new modern green collaborative buildings built, but it's gonna be a very long process.
And I would imagine it's more attractive to buy a distressed mall because you get all this land. It's in a great area. There's so many more things you could possibly do with it.
It is, so long as you can get the zoning and entitlements, which, we have examples here in Dallas. I have dear friends who own a huge mall, and they've owned it since 2009, and it's still dirt, So I would just say to you, if you're going to get in the business that involves, rezoning and entitlements, in these single family residential communities where a lot of these malls are, you better have a really long duration in how you're looking at the opportunity and the capital that you're deploying against it.
So do you have any interest in participating in what could be buying stuff for 80 cents on the dollar, buying stuff for land value, or are you just kind of like, let's keep watching this play out before we jump in?
Well, sir, if we think I'll make it up. If we think as a developer of multifamily that we can buy something for land value that used to be an office building, we'll be happy to tear down the office building and buy the apartment. We are not focused on converting office buildings to multifamily properties.
Yeah.
Does that mean we'll never do one? Does it mean we'll never finance one? I can't say never, but that is not something that our teams are focused on. And in terms of getting back into the office sector, so look, sometimes, you do things for one reason, it turns out to be really good. We stopped investing in office buildings about a decade ago, right? And we did that not because we saw COVID coming. We did that because the volatility of cash flows in the office sector is very extreme. And if you get the timing wrong, that can be very difficult. So we exited investing in the office sector, and we have zero exposure to the office sector. Again, we have this office development company where we have a killer mass timber building that we're building in Frisco, and then we have our own office campus here, but we have no office exposure outside that. So I don't see us, turning tide and chasing the broken office building. I think it's going to be a very difficult area. I think there are people who will make money at it. I think there are easier ways for us to make money.
I had Dean Adler on the podcast.
He is fabulous.
He effectively said that the fact that CapEx falls below the line on office is one of the biggest crimes in real estate. If you added it back above, then the value of every office building is essentially not zero, but it's cut in half almost overnight. Yep.
And I think the industry is moving in terms of underwriting. That's not a secret. It's kind of like the hotel business I said earlier, where 4% of FF&E is a lie, right? Yeah. I think the industry realized in the office sector after coming through this is never again will I quote NOI cap rates, right, on a nominal cap rate basis. I'm going to amortize tenant improvement dollars, leasing commission dollars, all the costs, and I'm going to see what the effective cap rate is. And I think the market's going to demand, right, a cap rate, a true economic cap rate, right? If multifamily's at 5, I'm making it up, I think the market's going to demand, I don't know what ultimately, but a 6 or a 7 economic cap rate on office buildings. And you're right, that's going to shatter values even in the best leased, best built buildings.
Have you, even though you probably wouldn't do them, you get to hear lots of ideas and see, entrepreneurs thinking about different things. Have you even heard of a scalable, viable business that's not just tearing down Class B office buildings for land, of different ways to use them that's even appealing to you? Or have you not really heard of anything interesting?
I mean, the only conversions is
multi.
Is multi.
But nothing more interesting than that. Data centers, people say.
I've heard some people talk about that, but I think as you get into it, you're like, it's the dumbest thing I ever thought about. Just tear the thing down and build a data center, right? These office buildings, like drive up North Dallas Tollway. So what do you do with some of those 1970s and 80s tilt up, 3-story suburban office buildings?
Oh, I know.
There's nothing to do with them, right? Yeah. So when they can't get filled up and nobody wants to put any money in it anymore, and the lender takes it back, they'll be like, okay, we'll sell it for land value.
So now putting your restructuring hat on. So what'll happen there is, current owner says, I'm toast, I'm not putting another dollar into it. Does the bank want to take it? I mean, they're kind of forced to take it back. You're kind of assuming the bank wants it back.
So I just came away from 2 days with a group of guys in my seat, at 80 of us, talking about this. And one guy was talking about, in New York, the lenders are happy to take the assets back, but he has an asset in Houston that the lender won't take back, But ultimately, at some point in time, that will happen. Ultimately, at some point in time, there'll be some short sale. Maybe the bank never wants to get in the chain of title. They'll do one of two things. They'll either work with the equity participant to just sell it as a short sale into marketplace, where the equity gets relieved of their liabilities, and the bank sells it for whatever they can sell it for and pay themselves, or they'll just flip the note to a hedge fund or someone else who'll just do the same thing.
Yeah. So at some point, you meet your maker. Okay. The next new thing is data centers.
Yeah. It's definitely the new thing. Yep. And you can look at it from a couple different points of view. It wasn't that long ago, and you're certainly old enough that you remember when life science was the new thing.
Yeah.
And
which is a rebrand of Office.
It's a rebrand of Office, but it's betting on biotech and all these things.
I'm kidding.
And it had a lot of capital chasing it, right? And now it's got its challenges. I think data centers perhaps have more fundamental demand than that. I just picked on life science. There is no doubt that the electronification of our lives, right? And I guess you can't live without talking about AI and things like autonomous vehicles. Like, there's just no doubt there's a need for more computing power. And these data centers for now, right, have to be housed terrestrially. And so the demand for that is escalating, and you can see it in what the hyperscalers, the Amazons and the Metas are willing to pay, right, to get access to this. And so there's a gold rush. There's a land rush going on right now. The business is all about power, though, right? It's all about access to power. And so this thing is running right now. There's hundreds of billions of dollars of capital, infrastructure funds chasing it, market participants. And it's got a lot of strong fundamental long-term, but you got to watch this thing, because whenever you have so much capital chasing an opportunity, I don't know the exact square footage because it's not quoted in square feet across the United States and data centers. I did see some data, no pun intended, that said it's 180 million square feet across the entire United States. So, and I know each square foot costs $1,500 a foot, so it's very valuable. But you got to start worrying about, right, when something gets so hot and so many market participants, so many entrepreneurs, so many young people, so many companies are focused on a sector that in the scheme of real estate is small.
Is it also an operating company? Or is it a real estate play?
It depends. If you sign if you do a build to suit for a hyperscaler who's going to run it for the next 20 years, it's not really your operating business.
Right.
You're just collecting a check. If it's a co-location facility and you have 50 different, 150 different customers, it's an operating business.
Yeah.
So it depends upon how you've leased it out.
Is the biggest risk that they continue to invent technology that you can get more for?
It's certainly a risk. I mean, I have been on the phone in the past week with people who've said, this may not mean anything to most of your listeners, we have a 5,000 square foot, 100 megawatt data center, right? When people say 100 megawatts, they're talking about hundreds of thousands of square feet. And it's like, well, we have this technology, and this was a major Wall Street private equity firm. We figured out the technology to really downsize this. I've had people tell me that it's all going into the sky, that the whole satellite revolution, that over time, and I do think over time, there will be obsolescence of existing centers. So yeah, if you build something today, believing that in 20 years from now, it's going to be market standard, I think that's a fool's errand. Now, but the question is, well, you might have a 20-year lease and it's being used, and so it makes all the sense in the world. I mean, it's going to have a useful life, but the industry has evolved and changed rapidly. If you sat here with folks who live this business, I mean, even 3 years ago, the product, even 2 years ago, the product they were building, even a year ago, the product they were building. So the obsolescence in this business is very rapid. But at some point, you got to build something because you got to provide the power and you got to provide the bits and bytes, out in the marketplace. Yeah. Just get it leased.
Let's talk about the two giants, multifamily and industrial.
Yeah.
How are you thinking about multi?
First of all, I am so glad those two sectors are where we focus much of our attention.
Yeah.
So in the near term, both of those sectors have excess supply, right? Both of them. There's no doubt about it. They were the belle of the ball going into, around COVID. A lot of capital came in, and we're overproducing for the market writ large. And that means in the near term, particularly in certain markets, we're having some downward pricing pressure. At the same time, we have these interest rates, and that makes people feel very uncomfortable, right? Values are down from the peak. And so the mood around the industry is in the current, environment isn't a great mood around the industry, but everybody in it knows that this is going to turn. Our housing affordability issue in America isn't going away overnight. We're not building enough single family homes for people. We're not really building enough homes for workforce housing. And everybody understands that this need is there. It's sustained demand, and the supply in the aggregate isn't able to meet the needs. And the other thing that we all know is new starts have finally collapsed. It was interesting that new starts continued to grow into the summer of 23.
Interesting.
Which was interesting about multifamily. Even though this interest rate cycle really started in January of 22, capital kept growing, new starts kept growing, but finally new starts are collapsing. And what that means is deliveries in 26 and 27 are going to collapse. And when deliveries collapse, it means the supply-demand balance, you're going to have rental growth. And so people are able to see out into 26 and 27. And it remains the stable bulwark of the real estate investment management and the real estate development industry today, I think, is in the multifamily space because everybody can see what I just said, and it's obvious.
Yep.
And the other thing is it's always leased, right? I mean, the really interesting thing about multifamily is you might not get the rate that you want, but you never have a vacant building. And there's a difference in actually paying property taxes, insurance costs, interest, security on an unleased building versus paying all those costs in a building that may not be leased at the rates that you thought. And so the risk profile of multifamily is just fundamentally a lot lower than the risk profile of anything else. On the industrial side, it's a different but similar story, right? I mean, we're going to deliver as an industry something like 600 million square feet this year, right? We have massive excess supply going on right now, but it takes such a short period of time to build these buildings. This time next year, deliveries are going to collapse. New starts in industrial collapsed earlier than multifamily. And so we're watching new deliveries in 2026 will be the lowest in 15 years. And at the same time, you've got wonderful demand forces at work. You've got not only continued growth in e-commerce, you've got this onshoring, nearshoring thing that's real. And particularly when you're in a place like Texas and you see what's going on and all these factories being built across America. And so you've got these fundamental demand, sustainable demand forces at work in the industrial sector, and new deliveries are going to collapse pretty quickly. It's been interesting to watch record levels of new supply. Vacancy is increasing, and yet rent rates are going up. Like, when have you seen that before, right? So rental rates are going up across the country, with the exception of a couple of markets. And supply is coming online strong, and vacancy is going up. And the reason is because customers, tenants want the modern boxes. So, we're seeing that. Almost everything we do is brand new, Class A, because almost everything we do very little acquisitions, even in the investment business. And so you're seeing for this modern product, customers need what they need. They need 40-foot clear heights, or they need parking, or whatever their needs are. And so being in the Class A part of this space, that doesn't mean to say that the entirety of the industrial space isn't interesting. But the part we're playing in is seeing, tremendous rental growth, notwithstanding all these supply forces that are at work right now. And I'm pretty excited about the next couple of years.
As a shameless plug, since we do Class B, kind of shallow bay, what do you think about it?
I think the thing you have going for you is you don't have new supply. And so you have a different customer, a different tenant base that it doesn't need a 40-foot clear height and doesn't want to pay those rents and doesn't need it, right? And so they're a business person here. Now you're going to benefit from the same forces. You're going to still benefit from e-commerce and onshoring and nearshoring. And yet you're not going to have people like us coming into your backyard and building another 50,000 foot, shallow bay, 18-foot building. So I think it's lack of new supply that will, continue to sustain that business. Because I think the forces of demand are at work just as much for you all as they are for us.
Why do you think industrial starts collapsed before multifamily? Was it having to do with interest rates available?
I've never figured that out. But I remember sitting there in the June of 23, right? And I was looking at the data. I was on a call with one of the big forecasters, and they were like, next month, multifamily starts are going to fall off a cliff. And I was like, why next month? Like, why didn't 3 months ago? And, you'd expect it in the first half of 22 that people had committed to things, so they went through with it. But you're the first person to ask me, like, why did multi behave different than industrial? I'm not really sure. I'll come back to you on that.
Okay. Why don't y'all acquire much? Why is it just...
No, we do. We do. Let me step back. We've talked a lot about our development company, and we talked a bit about our real estate investment management business. In that business, and it depends. There are points in time in the cycle where all we'll do is acquisitions.
Okay.
Right?
Got it.
And there are points in terms in the cycle, but we're active in that business in the self-storage space. We're active in that business. We're very active in the manufactured housing space, right? And that's almost all acquisitions. We're very active in the convenience and gas. We've been for 20 odd years, investing in convenience and gas stations. That's really another form of retail. That's all acquisitions. We're active in student housing. Sometimes that's development, but a lot that's acquisitions. We will acquire multifamily properties, and we do acquire multifamily properties. The value add acquisition business in multifamily is very important for us. And I think over time been substantially bigger than the multifamily development business as an investor. It's really just an industrial where we just haven't been able to make the math work. We have not historically had core capital, and acquiring quality industrial assets. Now, maybe if we were in the shallow bay space that you're in, maybe from a return perspective, we would have seen, more value add or opportunistic returns, but it's really been on the development side. And we've been comfortable I think just to think it through, remember that the DNA of the firm going back 75 years, we're really comfortable with development. We understand it. And so that DNA rubs off, even though it's in another part of our business.
Then let's just talk about just development. And you can give a short answer, a long answer. We were talking about it at lunch. It's just harder to do. It's taking a lot longer. Yep. There's more permitting. Like, it's just death by 1,000 cuts.
Absolutely.
And because the DNA of the firm is we've done it for 75 years, like, do you ever wake up and you're like, should we be doing this anymore?
I'm going to give you just a fact in the current cycle about the benefits of doing it. Okay. So if you had bought industrial in the United States, 2021, 2020, 2019, 2021, you would have bought at a 3.5 cap, a 4 cap, a 4.5 cap, whatever you would have bought.
That's for Class A stuff.
Yeah, for Class A.
Yeah.
And I don't live in your world every day. And this downturn occurred, and all of a sudden those assets are worth 5.5, right? You just lost 20% of your value, right? If you were developing and doing spec development, you might have underwritten a yield to cost of 5.5. But because of rental growth, you're actually leasing these things up at a 6.5. And so industrial development, notwithstanding the risk that you highlighted, has turned out to be a much smarter investment decision than the industrial acquisition business, certainly at this point in time in the cycle. And I can also tell you, like, at least our track record, the returns we've delivered in industrial development, over the past decade, really swamp, what I see in the marketplace, what the industrial acquisition returns have been. And so it's all about risk return, right? If we can't deliver that multifamily property at a, you pick a number, 150 basis point spread, to current cap rates, you're just getting a better return. So is it worth the risk? That's up to each investor to decide. But we're pretty good at this, and we manage those risks. There are headaches that we deal with that our investment partners don't deal with. Yeah. But that's just how we earn our daily wear.
Okay, a couple capital markets questions. Y'all are taking in money from all over the globe, really. Pensions, sovereign wealth funds from different countries. What is just the appetite in general right now for money getting into real estate in America? Are we getting closer to people getting excited, or is it still kind of meh?
I think it's gotten worse.
Okay.
I think look, you can see it in the data. You can see the fund flow data. There are people who track this stuff. There's no doubt that this has been coming down. And particularly, like, I've been watching the past couple of months, like, it just seems there's a bit of a malaise, a fatigue that's in our industry writ large right now. And I'm watching global fund flows. They're not getting as much money back from their historical investments because the distributions aren't coming in. The headlines around our industry are terrible. If you're sitting in a foreign country and you're reading about the United States right now, what are you reading about, right? You're reading about, political dysfunction, you're reading about inflation, and you're reading about a real estate crisis, right? And so on a global basis, fund flows have come down. That doesn't mean it's stopped. It doesn't mean there's no investment activity taking place domestically, but fund flows are continuing to come down. I don't know when they'll reverse course. A lot of institutional investors make annual allocations, right? And so they'll sit down typically at the end of the year thinking about the next year. And so they were sitting there at the end of 23 in the environment thinking about 24, and at the margin, then they're looking at their performance, and the performance of the past year was poor. And they're sitting there competing for capital. And there are folks on the credit side saying, we're going to invest in this real estate asset, and I'm making numbers up, at a 12 when I can go and buy corporate credit at a 14. And the relative risk-adjusted return when you're a macro global investor, people have just seen better relative opportunities largely in the credit space. And so funds flows have moved there. And so the markets will need to shift again. Real estate will have to become relatively more attractive.
Yep.
Credit will have to become relatively less attractive. And as that happens, fund flows will reignite back into the sector, I think.
And I think you just answered that, which is just you're seeing the fatigue setting in. We're 2.5. If you're not in real estate, you don't really realize this has been a 2.5 year long deal.
Yeah. And you see that fatigue in the human condition across the industry.
Yeah.
And it's not just young people.
Yeah.
Who haven't been through the cycles. And it's been very interesting because I've noticed that. You remember back in November when rates dropped, the 10-year fell to 3.9, there was some exuberance.
Yeah.
People were getting excited.
Yeah.
And then month by month, it slowly, and then it kind of, once it got back up, people are like, deflated.
Yeah.
So there's definitely a malaise and a fatigue across the industry right now. And, be careful of that. Real estate's not going anywhere, right? The opportunity is not disappearing. We have a country, the American economy is the most resilient, strongest economy in the world. We have population and immigration growth in this country. We have a potential for productivity growth and, through technology. Like, don't let this malaise or fatigue eat you, right? Like, now, if you're waking up every day and all you're dealing with is getting your teeth kicked in and restructurings and recaps, that's not fun, right?
Yeah.
And that's really hard. It's a hard emotional thing on people to go through that, right? But try and pull yourself out of that and start thinking about how to position yourself for continued growth and opportunity. Even if it's not deep distress, we're going to have growth again. I mean, we have growth and we're going to continue to have that.
And I think I know your answer, but whether you're young and you're just coming out of college or you're in the industry, I think you'd say like hang in there because these are going to be some of the best learning years. And when we come out of this, you'll be much more well equipped.
Yeah, sure. And all things being equal, I'm going to make it 2024 should be a good vintage, for lack of a better word. And look, if you've been doing this for a while, you've lived through cycles. This isn't an industry that's going away, right? Like, I recognize some people are going to get shaken out, right? Because they get let go or there's no job for them and they're going to have to find employment in another area and that's going to carry them away. But if that's not you to like give up on the industry because of a few years of a cyclical downturn, like you're going to give up the best part.
Okay. You've now been at Crow for 8 years.
Almost.
What are you most proud of? Like, whether it's the team, what you guys have done, anything you've changed, like what you're now 8 years into the job. What's interesting to you?
Well, the first thing I'm most happy about is that I didn't screw it up, and when I say that, I don't mean like I was, I want to be clear. I was going to come up from a business perspective that it was going to be a cultural fit, that it was going to work, that there was going to be love and trust and relationships and fun. And like, that's the thing on a very personal level I'm happiest about and fulfills me, in terms of the business. Like, it's been, first of all, our real estate investment management team is run by a guy named Bob McLean, who is the best chief investment officer I've ever met. He is incredible at what he does. We've got a guy named Ken Valak who runs a development company. These guys are the best in the business. And so to work with them, to work with those folks and to work with Harlan and Ann and the board, but to work with these people to grow the business and create opportunity for the people that work here. We've grown the business, right? It fundamentally has happened, right? We added more offices. We opened up, we moved more, we moved more people into more opportunities. We took young people and moved them into more senior positions. We started new funds and raised new capabilities. I'm happiest and proudest about that. We created growth and opportunity. At the same time, we delivered terrific returns to our investment partners. So we have this nice virtuous circle working in the business right now. Those are the things that I'm most pleased about for the organization. It's fun to work on a new business like the energy business, which was really important. We didn't talk about it. We have a terrific team of people building community solar across the United States, and we're learning from that. So on the energy business, I'm learning a lot. We're growing a lot, and it would be really neat. It'll be really neat to look back and can we turn that into a pillar of the firm, right? So that's exciting, but that's not completed, right? That's a work in progress. The other things, their business is always a work in progress. But to see these young people grow into opportunity and develop their careers and create opportunity for themselves and the family, that's just the best part of the job.
We didn't talk about solar, and I asked you at lunch because you're a man of commerce, and I asked you, are you doing the solar because it's kind of a check the box ESG thing, or are you doing it because you're a man of commerce and you actually want to make money and make returns? And you said, well, what do you think I'm doing it for? We're doing it to make money. How did you think about getting into it, and why did you get into it?
Sure. We first started about getting into infrastructure, the word infrastructure, as an investment manager. That led us down a path of, well, maybe we'll focus on the energy sector as we dug into the energy sector, we realized that the opportunity, at least for us, we viewed it more from the developer side. We just said, we're a developer by heart. We understand this business. Instead of going at it from the investment management perspective, let's go at it from the developer's perspective. We're really good at this. We have an edge. And as we looked at the energy business, I already outlined for you why the traditional business was attractive. But on the renewable solar point, it is clear that our society in America today and globally is going to push more and more and more for renewables. No matter what your point of view is, that is baked into the cake. And over time, someone has to build this stuff. At the same time, the federal government passed the IRA, which made tax credits transferable. At the same time, America was building solar plants in America now away from China. And you just saw this sector is here to stay. Each state has other programs or subsidies or activities. And so we put together, there's a macro secular trend at work here. We are a developer by background. We should have an edge tying up land and, building community solar farms across the United States. We have tons of buildings across the United States. Some of those industrial buildings are going to have solar on it. So we put all these pieces together, and we had a terrific guy who wanted to go lead the effort. And we're now in 5 or 6 states, and the solar business today is both about solar production as well as battery storage. So in places like Texas, where the cost of electricity is so cheap, and I'm sure your listeners remember a couple of years ago, we had some grid stability issues. We need more battery storage, in Texas. And so we're in the battery storage business, working to stabilize the grid, as well as in other states trying to build solar farms. And it's not easy, right? You got to make the math work. And then from a regulatory perspective, you have to get the right to connect into the grid.
Right.
And that's a regulatory issue. And that's not always easy. So that's why we got into both those businesses.
Okay. A couple more. Maybe it was at lunch or maybe you said it here, but you just said, don't think of don't go back in history. There's certain things about our industry that have just changed significantly. How we capitalize things. I think you mentioned that 53% of the real estate equity in America goes to 10 players.
Yeah.
That's probably going to that trend's probably going to be on its way. So you said, as you think about the future, don't always pull from the past.
Yeah.
Can you expand on that a little bit as you're talking to your team about the future? What might be some things to let go of or not necessarily anchor into that would be things that maybe an amateur or somebody that doesn't know better would just continue to anchor into?
Well, there's 2 elements of it. One is the physical buildings that we build, and you take a snapshot of a hotel over the past 100 years, every decade, or an apartment building. The buildings are always changing, and the obsolescence curve is going up. So that's just something you got to remember that. But what we were talking about was more is how is the industry capitalized? And remember, the real estate private equity business started in 1990, basically. It started with opportunity funds to take advantage of the RTC. Even as they grew through the next decade, there was no idea that these firms had any value, right?
Yeah.
Today, the business has turned into, yes, the investment management activity and what's taking place. I mean, that's why we have a business, but where I'm really going to make my money is owning the investment management company, right? And selling the business at a multiple of earnings, right, to some other consolidator. And that's all happened over the past 30 years. Those big consolidators are now, the bigger are going to get bigger, and they can continue to get bigger. And so the cost of entry into that business and to get your business started and up the curve and to be able to compete with those guys is going to get harder and harder and harder. Doesn't mean you shouldn't do it. It's just what's happening. And so when you think about it from an entrepreneurial perspective, I'm going to start out and be the next big real estate investment manager, and I'm going to grow to Blackstone size, or I'm going to sell myself. I'm picking on Blackstone. I shouldn't do that. By the way, they're fabulous. Those guys are terrific. And
they're the best.
And so I'm not sure, as a young person starting out that, that's the right business model for you. It is also clear, remember, institutional investors 30 years ago had very little exposure to real estate.
Yeah.
Right? They now have a lot of exposure to real estate. They're much more sophisticated. They're much more targeted in the way that they're allocating the capital. And so, maybe a business model going forward, and they want to be in many instances closer to the real estate, right? There are those 10, 20 firms, the largest firms will continue to raise a lot of funds, but more and more large institutional investors want to go direct. They want to go direct to the operator. They want to go direct to the developer. And so maybe that's the better opportunity for you going forward, because as the institutions get larger, they may still do business with the big fund aggregators or the fund allocators, but they're going to do more and more capital direct with the underlier operating developer. And look, we could spend a lot of time on this. There was the development of the RMBS market, the CMBS market, the REIT market, the private equity market. Remember, the real estate debt fund didn't even exist 15 years ago.
Yep.
Right? It didn't even exist. It came out of the GFC. And so you've got to watch these capital markets as they move over time and try and imagine where could this be going? What are the trends, as opposed to, well, I saw this happen over the past 30 years.
Okay. And maybe you're already seeing the early crumbs of this, but what is, if we sat here 15 years from now, what would we say is the thing that didn't exist that exists? And maybe it's because you're already seeing it in tiny bites already, but what's coming? What doesn't?
I just had this conversation.
Let's go, baby.
No, with some really sophisticated, folks in the industry. And I think we're all saying, I don't know, because we're not seeing it. And this is the thing I've been most curious about, right? Just because I've seen the advent of all these things, right? Not all of them. I wasn't around for the RMBS, but it's like this office sector, isn't there going to be some kind of vehicle, right? It doesn't fit into a REIT format because it's not predictable, stable earnings. It doesn't fit into private equity because it can't be IRR driven. It's got to be really, really long-term capital. Shouldn't the global capital markets figure out some new vehicles to put all this office exposure in and deal with the 10, 20, 30 years restructuring? Can you securitize that? You can't really securitize it because there's no predictability in it, right? Securitization works when you have predictable cash flows. That's the area that I'd be most interested in sitting down and trying to brainstorm, but I haven't figured it out yet. And I haven't seen any. Someone's probably going to listen and say, I invented something, but and great, I'd love to hear about it. I haven't seen in the capital markets any new inventions coming out in the past couple of years in response to the current environment, but more importantly, this office sector, environment.
We'll put your cell phone number in the. No, I'm kidding.
No, I'm really I've said this before. I'd love to talk to people who have the ideas and learn from them.
Yep. All right. This has been an incredible conversation. I think we'll end it there.
Great.
Thanks, Michael.
It was a pleasure, Chris. Thanks for your time, man.
It was awesome.
All right. Be well.